Hi everyone, thanks very much for tuning back into the show. So in today's episode, I'm joined by Jay Anderson from Jay Anderson Property, and we're going to have a discussion primarily around commercial properties. If you'd like to get in touch, I'd love to hear from you. Please send me an email at jp@australianpropertypodcast.com.au or give me a call on 0423 475 336. All right, let's get started.
Welcome to the Australian Property Podcast, helping you achieve success in property. Featuring your host, Jonathan Preston.
Alright, so please note, as always, everything discussed here is done so for entertainment purposes only. I have not taken into account your personal circumstances nor your risk profile, so you should seek professional advice before making any investment decisions. So today I am joined by Jay Anderson from Jay Anderson Property. He is a commercial specialist, also does residential, and I thought I'd bring him in today because he knows a lot on commercial, a lot on resi as well, but we talk about resi on here every day anyway, so thought we would talk about commercial for a change today, and with him being an expert, I thought it would be great to have him on the show. So I'll hand over to Jay briefly now so he can do a little intro, tell you a bit about his background and his business there, and we'll start the conversation from there. So thanks for joining us today, Jay.
No, thanks for having me, Jonathan. Yes, my name is Jay Anderson. I'm a property buyer's agent from Jay Anderson Property, and we specialise in acquiring high-performing investment-grade properties in emerging markets right around the country. It compromises of both residential and commercial property. My background in commercial property is my family's actually been buying and selling commercial property since the 1950s, predominantly motels, which I'm now also invested in addition to the residential side.
Awesome. So thanks so much for joining us. I want to also mention here that this is not a paid advertisement or anything like that. Jay's just a good guy. We've talked a bit, and he's taught me quite a few interesting things, actually. So I thought, look, we might have him on the show, and that way we can talk a bit more about commercial, and I think hopefully a few people will be interested. So I guess to get started on it, we are sort of seeing a bit more interest in commercial these days, particularly with residential, tightening up so much, not only in terms of serviceability, but just sort of the compliance and regulation around it in general. So I'm seeing more and more interest in commercial. And so I guess I want to ask you, Jay, are you seeing more interest in this space, and what are sort of people looking for here? And I guess, what are your thoughts on commercial in the current market?
Yeah, definitely seeing an increased interest in the commercial stuff, and I guess it's a mix of both of what you said about servicing and I guess gross yields in residential, can look great on paper, but once you take out all the expenses and you get down to a net yield position, it can get tough, and so growing interest in commercial from both people wanting a stronger yield in their portfolio, but also the other one is with baby boomers. With the more and more baby boomers transitioning into retirement, a lot of them are asset rich and cash flow poor. And when you think superannuation only came in the early 90s, so a lot of them might not actually have enough to self-fund their retirement out of their super. So they're looking at maybe selling down some of the resi stuff, or just purchasing commercial so they can fund their retirement and maintain the same lifestyle that they're currently living.
Definitely makes sense, and I think a lot of people have seen that the yield difference is substantial, and especially when you factor in gross versus net yields and everything. So that definitely makes sense. I guess the sort of question that probably a lot of people are interested in is, being a buyer's agent and doing a lot of commercial. What is it that you like in the market at the moment? Obviously, we've seen commercial run up a bit in recent times. So would you be able to, I guess, elaborate a little bit further in terms of the kind of things you like in the market, sort of locations, type of security, any other info you're happy to provide?
Yeah, so really strong on both accommodation assets, so like motels in strong regional towns, and also medical and healthcare assets. So the medical and healthcare stuff, typically anchor tenants, they're higher income earners. They're very location-based businesses. If you think of the dentist when you're a kid, chances are it's probably in that same location. Good yields of kind of the stuff we're buying in that medical space are kind of 6 to 8%, depending on the location and the value. Being medical and healthcare, we're an aging population. It's a ever-growing demand on healthcare services, and also it's a non-discretionary spend for Australians. So regardless of what the economy is doing, we still look after our health, and we still need to rely on these services. In the accommodation side, strong regional towns that have got a diverse local economy. We like to target areas that have a larger population as well. So if you're thinking of your major regional hubs in those sorts of areas, starting yield for motels are kind of 8% upwards, 30-year leases, tenant pays 100% of outgoings. So they're the two primary ones that we really like, and I guess those are the main reasons why. In terms of locations, probably like those largest satellite cities. And then the major regional hubs as well. As soon as you start getting closer into the capital cities, yields get compressed, and it's for a mum and dad or small scale investor, it doesn't look as attractive.
All right, excellent. Makes sense. In terms of, I guess, some recent transactions, would it be possible to, I guess, give me just some brief outlines? We don't obviously have to get into specific addresses or specific prices, but I guess just a framework in terms of, I guess, some of the transactions you've seen go through recently. Obviously, everyone's a bit different, but could you give us a few examples as to some ones that you've done in recent times?
Yeah, I'll give you an example of one we're actually looking at the moment. We're trying to get across the line. It's a pathology lab in the northern part of New South Wales. Great location. Pathology lab downstairs, and upstairs is actually 2 residential 2-bedroom units. So the idea behind the purchase is maybe looking at buying it and strata titling it, and then you've got options to either sell or do whatever with those resi. Purchase price is just under 1.8 million. And be delivering a net yield of 7.23%. So when we can find a commercial property that's got a bit of that X factor, a bit of something different we can do with it, that's obviously really attractive.
Awesome. And then I guess elaborate a bit further on that topic. So obviously you've got that background, of the investments you've made and everything. Would you be able to sort of, I guess, give me an example of sort of a success story you've had in the past? I guess just as specific as you can, and that way I guess it will potentially be of interest to a few people. Would you be able to elaborate, I guess, on some of your past successes there?
Yeah, so one that jumps to mind is a motel that was bought in a strong regional town in Sydney, in New South Wales. Purchase price was 2.7 million. It was running at about 18% occupancy when we bought it. The average occupancy in the town was 58%, so we knew that the business in the town was strong, but the actual business, the motel, was poorly managed and poorly run. So bought that, and then actually on-sold the lease on the business, maintained the freehold. And as the value of commercial property is almost directly pegged based on the rental income, the net yield on that property now after 3 years is 12.75% net.
That's fantastic and hard to argue when your yields are that high. And I guess that brings me to the topic of capital growth. So obviously a lot, in commercial is a bit more yield based, but I guess I'm curious as to your thoughts on how capital growth might look. I guess maybe we put Sydney and Melbourne in one basket, and then sort of other major metro in another basket, and then sort of regional in a third basket there. Obviously, none of us have the crystal ball, but what do you think people can realistically consider for growth in terms of commercial purchases? Obviously, excluding the yield there. Any sort of thoughts or ideas around what we might see in the future there?
It's always a tricky one to put a number on, especially in the commercial space. What I do think is with the increased interest levels in commercial, we are going to see continued compression on yields in the commercial space. We've definitely already seen that in Sydney and Melbourne, and I think that's just going to have that ripple effect out to more regional areas, especially if we're going to have, some more interest rate cuts potentially coming up. That's just going to, affect that even more. So it's hard to put a capital growth number on it. I do probably say that we always try and find properties where you can maybe do something to the property which can improve the capital value of it. So some little things we can do there is, let's say if it was a restaurant, and it didn't have air conditioning. You could go to the tenant and say, if I was to put air conditioning throughout the premises or any other small works that you want done to the premises, we will fund it in return for a slight increase in the rent. So you can do that, and then as the value is directly pegged in terms of rental income, that will increase the capital growth. So we can do that right from small scale stuff as aircons right through to, we've done it of resurfacing car parks.
Okay, awesome. And then I guess, being an expert in the industry and having seen a lot of transactions, maybe let's cross over to the other side. So I guess, would it be possible to outline, I guess, some of the things you don't like in commercial and perhaps some of the mistakes that you've actually perhaps seen people make and, I guess things people suggest to you that you think isn't a good idea. So I guess, could we go into some of the things that you think are a bad idea in commercial?
Yeah, definitely. This is always an interesting one. I guess the two big ones for me are retail, especially the small scale retail, and also small floor space office in large buildings. From the retail side, I'm a firm believer that the retail is the forefront of the economy, as in it feels the pain first when an economy is struggling. Typically, it's higher turnover, long vacancy. In the smaller scale retail stuff, they're not A-grade tenants. So it's higher risk, longer vacancy. Just not keen on retail at all. And then from the office space stuff, with a lot of companies with their office, if they picked up and moved their office to the next suburb, it wouldn't impact their customer base. So then there's no real incentive for them to stay and be a secure anchor tenant because they can pack up and move quite easily. Pack up the computers, relocate, send an email out to their customers, and there's no real major impact. So they're the two ones that, I'm not keen on at all.
Okay, cool. So then I guess, moving on, I guess, from that, are there any sort of things, you would say, as like a starting point for someone who wants to start, getting into commercial, I guess it's hard to put an exact dollar value on it, but, if someone's starting out, I guess what are some of the things in terms of like a process of elimination in terms of perhaps, where they could start out, what sort of minimum sort of stuff they might be looking at? Are you able to give any sort of rough parameters around that?
Yeah, I guess for in line of the type of stuff we like, if we go through a process of elimination, so if we remove those small retail, the small office space, look at the more attractive yields without making sacrifices on location, so excluding those real remote areas. So if we're wanting satellite cities or strong regional hubs, not retail, not the small office space, it's kind of coming back at it around that 500,000 mark. Upwards, you could probably buy a little under that, but that's a good, I guess, rule of thumb.
All right, excellent. That makes sense. I think that people are sort of aware there's a little bit of a higher sort of threshold to start out in commercial, especially because of bigger deposits and that kind of thing. But definitely, I think the yields, show through what the actual returns look like. And I guess one of the real key things I would like to pick your brain on here as well is that, being, having spent so much time in this industry there, are there any kind of secrets of the commercial that I guess most people wouldn't know, that you could sort of pass on to our listeners today? Any thoughts that you can share there?
Yeah, certainly. So I guess the big thing is really doing extended due diligence on the tenant or the type of business that's going to be occupying the premises. So we want to make sure that it's an in-demand business for that local area, and also that is not a market saturation of that type of business in that area. When we want a tenant in a commercial premises, we want them to be successful and long-term in their business. So we want to make sure from a business perspective, does it look like it's going to be viable and long-term? So there's a lot of emphasis that goes into, I guess, researching the actual tenant themselves. Me personally, I always like to try and find, if it's a tenanted investment, that they've been there for at least 6 months. So they've got 6 months of rental history in that location. Ideally, it's not just a business that's 6 months old either. Hopefully they've got a track record in a different location, and they've maybe business has grown, so they've moved into a larger premises. try and get an understanding of who's actually running the business as well, and some, a lot of background on it. Also have a look at some of their competitors in that local area. How are they trading? What's their history been like as well? That can give you insights into how that business is actually going to perform in that area. Other things, I guess, like making sure that there's a diverse local economy, same as when it comes from, I guess, resi investing. Even getting down to looking at, I guess, population growth numbers and understanding the demographics. If it is in a medical area, try and get an understanding of the demographics that live there, and if there's a population growth happening, what's the makeup of that demographic. I think did a report a couple of weeks ago, and we're looking at a property in Central Coast, I'm not paraphrasing here, but has the highest number of over 80-year-olds than any region of Australia. So you think the demand on medical is going to be very strong in that market. So I guess understanding the dynamics and the fundamentals behind it.
Okay, awesome. I think that's a really good tip, because I think, a lot of us who come from that residential background, we sort of, look for who can afford to pay the rent, and, as long as they've got an income, we sort of don't scrutinize it too much, more harshly than that. But when it comes to commercial, obviously, a different kettle of fish in that, the actual tenant is reliant on their business being successful, and then that flows through to them being able to stay as tenants. So I think that's a good tip there. I guess one other thing I really wanted to ask about is sort of, any sort of horror stories that you've heard, I guess, in recent times, whether it, just, I guess, across property in general, I guess, as much commercial stuff as you've heard, and any financing stuff, and it's just any bad stuff, I guess, that you've heard in recent times, and things you think, people might find interesting or should be careful of. Any sort of thoughts on that?
Yeah, I need to be careful with how I answer this one, but there was a national family-owned food business that had been in a location for about 5 years. They ended up not taking on the option period on their lease and moving. An investor bought the premises, and then they found a mum and dad business operator who wanted to move into that location to open the same type of business as that was previously there. Part of the lease agreement they had with them, they gave them a 3-month grace period on the lease so they could get in, get set up. In return, it was a slightly higher rental income. That was the compensation for the grace period. After the 3-month grace period, in the 4th month, the business went bust. They worked out that they couldn't actually run the business as a profitable business, and they went belly up within 6 months of actually opening. The funny thing was, I guess, if this national, highly successful food company couldn't make it work in that location, what chance did a mum and dad investor in the first time they've been in this industry doing it? So I guess that's one of the bigger horror stories, and that's, that was in the last 6 months.
Awesome. I guess definitely makes sense, and always interesting to hear where things go wrong, because you always hear all the amazing stories of how successful everyone is, but it's always interesting to hear some of the flip side stories as well. I won't keep you for too much longer. We really appreciate you coming in, but for anyone who'd like to get in touch and have a discussion with you, please let us know a little bit more about your business and how people can reach you.
Yes, my website's janderson.com.au, or if you type in J Anderson Property to any of the social media platforms, you'll find me. And always more than happy to chat anything to do with property, whether it be commercial or residential.
Awesome. So thank you so much for joining us today, Jay. I hope a few people found this of interest. Please note, as always, everything discussed here has been done so just for entertainment purposes only. We've not taken into account your personal circumstances nor your risk profile, so you should seek professional advice before making any investment decisions. As always, we'll be back next week, and thanks so much for tuning in. Thanks again, Jay.
Thank you for having me. It's been a pleasure.
Thanks for listening to today's episode. Please subscribe to the podcast, and if you've enjoyed the show, I'd really appreciate it if you could leave a review on iTunes and recommend the show to any friends that you think might benefit. Thanks again for listening, and we hope to see you back soon.